Now let us talk about what has happened in the markets over the last quarter. I'll be breaking this update into two distinct parts. The first part will revolve around the price behavior of the S&P 500 and Asian equities, while the second part will dive into the three big themes that has occurred in the last quarter, which is worth keeping an eye on. Now in terms of price behavior, the first quarter of 2023 has been a roller coaster ride, with both the S&P 500 and Asian equity experiencing a massive run-up in prices throughout January, only to come back down in the month of February and month of March. Now the rally in January can be attributed to the optimism that the global economy can address the inflation problem without causing a painful recession. That said, as the month progresses, investors' hope of a soft landing is slowly dashed, as the strong economic data suggested more regressive rate hikes to come. Now this had eventually led to the banking crisis that saw the collapse of regional banks like Silicon Valley Bank and Signature Bank, which is caused by a combination of both a poor management and the impacts of a higher rates that made the banks insolvent, spreading fear throughout the market and causing the market to come crashing back down. That pretty much covers what has happened to the market over the last 3 months, and let us now move on to the three big things that are worth keeping an eye on. Now the first thing that investors should watch out for is how the US government and the Federal Reserve will be tackling the ongoing banking crisis, while concurrently trying to tackle the ongoing inflation situation. On one hand, with the fall of SVB, the Federal Reserve now has to deal with systematic failures caused by the management's greed and stupidity, which will deter the effectiveness of its ongoing quantitative tightening, as the bailouts will increase their balance sheet, while promoting moral hazard, which will increase the risk of future systematic failures. On the other hand, to address the inflation situation, the Federal Reserve has decided to continue with its current pace of rate hikes with a targeted terminal rate of around 5.1% this year, which is consistent with its previous expectations. But the move may potentially result in more systematic failures, as a higher cost of borrowing flushes out any unsustainable business model and poor corporate practices. That said, only time will tell if that happens, which is why investors should pay attention to how the situation pans out and whether the Fed will pivot should more systematic failure materializes. The second thing that investors should watch out for is the plausible expansion of the BRICS, which for those who are not familiar with the term stands for Brazil, Russia, India, China and South Africa, which together represents the fastest growing emerging economies in the world. Now as a result of the Russian-Ukraine conflict coupled with the strengthening of the US dollar, there had been a sudden increase in cooperation and collaboration among the emerging countries, which had essentially revived the interest surrounding the BRICS to an extent where other emerging countries are expressing their interest to join the bloc. Countries such as the UAE, Saudi Arabia, Indonesia, Iran, Argentina, Mexico and many others has expressed their interest in joining the BRICS, as the relationship between the emerging countries had deepened as a result of their desire to reduce their dependency on the West and the USD, given the pain that the West had caused to their economy during 2022. Now while the BRICS have been pretty negligible in the past, with the ongoing developments, it is worth paying attention to how the bloc may turn out, as together they account for over 40% of the global population and are often rich in natural resources. Now should the bloc expands and the political and economical relationship between the bloc members improves, it will be a positive development for the emerging countries, as they can now trade directly with one another without the influence of the West and potentially tap into a significantly larger market that was previously ignored. Now this will be a headwind for the West and especially the US, as that will mean that the reliance and the demand for the US dollar will decrease. As a result, it will put a dent in the West's global influence, as their ability to apply political pressure via threats of a sanction or trade blocs will be significantly impacted. In short, successful expansion in the BRICS will be a positive economic growth factor for the emerging markets, and it will be a negative economic growth factor for the collective West, as the balance of power shifts to be more even among the developed and the developing regions. Now the third thing that investors should watch out for is how China's economic recovery will play out on the global stage. In a contractionary environment where central banks all over the world are raising interest rates to combat the effects of inflation, China is one of the few countries that adopt an expansionary policy in hopes to spur on their economic activity that was disrupted due to its previous COVID lockdowns. In fact, China's GDP is expected to grow at around 5%, and the party has expressed their intention to do whatever it takes to revive the economy this year. However, in an interconnected world, it is inevitable that the global headwinds will pose a large threat to China's ability to deliver its economic growth target should other economies fall into a recession or worse, a depression. While China's economic activity and consumer demand had shown signs of improvement, the sustainability of the recovery is still questionable as long as the global headwind persists. That said, in a contractionary world, China's expansionary policies and coupled with the growing economic interest among the BRICS nation is definitely worth watching closely, as it may eventually develop into a new factor of economic growth for China and the rest of the emerging markets. As stated in my 2023 market outlook, I expect the next 18 to 24 months to be a rough time for the markets as prices will remain depressive. But as long as we can get through this period, which we will eventually, we will look back at this episode as a possible opportunity of the next decade. Now 2023 will be a good year to accumulate and load out more undervalued investments, especially those in the Asian region, as prices continue to fall and remain depressive at the back of fear and pessimism. This is the exact time that we buy low and sell high, by embracing the pain that is bound to happen this year and positioning ourselves for the eventual recovery. If you'd like to find out more about how you can navigate the market and accelerate your wealth accumulation progress, you can download a copy of my book, The Price of Financial Freedom, which will provide you with a comprehensive guide to help you achieve financial freedom and live life on your terms in the shortest amount of time. You can download a copy of it for free on my website. The link will be in the bio or the description box below. Do also subscribe and follow my account to stay updated with future investment updates and market analysis.